What is top-down analysis? Have you ever heard this term before? Do you have any idea what it means or how to put it into practice? Well, in this video, you'll find answers to all these questions. Get ready because you're about to learn some incredibly useful information that will take your trading to the next level. Let's dive in. When we open our chart to perform a top-down analysis, we will need three main steps. To briefly summarize, these steps are as follows. On higher time frames, we determine the overall direction. This gives us a significant advantage in deciding the type of trade we will take. Typically, we analyze daily or weekly charts on these higher time frames. Afterward, we move to the medium time frame, such as the 1-hour or 4-hour chart. This helps us observe potential trade opportunities. In this stage, we identify key zones, which will guide us as we transition to the lower time frame. Finally, we move to the lower time frame, where we confirm the price reaching the zones identified in the medium time frame and turn these into trade setups. We can refer to this area as the trade zone. For lower time frames, 1-minute, 3-minute, or 5-minute charts can be preferred. By completing all these steps, we will have moved from the bigger picture down to the finer details, successfully completing our top-down analysis. This method, which is advantageous and profitable for most traders, will also teach you how to apply it correctly, step by step. So, let's dive into a live chart and see how we proceed. Now comes the most exciting part. Yes, I'm talking about analyzing the chart. In front of you is the Euro to US dollar chart on the daily time frame. Before I explain, I'd like to ask you a question. Do you think this chart is moving sideways, trending upwards, or trending downwards? I'll give you 10 seconds to think about it before revealing the answer. If you've made your decision, let's continue and see if you're reading the chart correctly. When we look at a chart, we can encounter three possible directions. The price is either moving sideways, trending upwards, or trending downwards. According to the rules of our strategy, we aim to take trades in the direction the price is moving. When analyzing the price from the beginning and looking at this chart, it might seem to you that the price is moving sideways. However, if you ask me, the price is actually in a slow upward trend. Why? Because as you may have noticed, the price is creating higher highs while maintaining its lows, and it isn't pulling back to the liquidity zones near the lows. For the price to be considered sideways, it would need to take out both the highs and lows while consolidating within a specific range for some time. That's why we're observing a slow upward movement here. Everything seemed to be going well up to this point. But then, what do we see? The price breaks the last low and starts to collapse rapidly, creating new lows and shifting into a downtrend. Since the price is dropping quickly and shows no signs of either an upward or sideways trend, our directional analysis for EOR-USD is undoubtedly bearish. This means that when we move to the medium time frame, MTF, we will focus on looking for sell opportunities, aligning with the trend. So, if we've identified a bearish direction on the higher time frame, let's now move to the MTF to continue our analysis. Before we continue with the video, I need to give an important reminder. When you switch to the MTF, which strategy will you use to make your plans? This is where you come in. You might be a supply and demand trader, you might be trading with Fibonacci, or perhaps you're using smart money concepts. The key point here is that when you're looking for trades on the MTF, you should be looking for trades based on your own strategy. It's not necessary to follow exactly what I'm doing. Please keep that in mind. Yes, right now we are on the 1-hour chart, and when we analyze it, it's clear that we should be looking for sell opportunities as the price is struggling to stay afloat. Additionally, since we've already received confirmation for a bearish direction on the HTF, it will be more profitable to set up trades in this direction as well. Now, I'm going to show you an area that caught my eye. Take a look at this candlestick. Notice how it's a large bearish candle and the price has dropped, leaving a gap behind it. When I closely examine this area, I can see that liquidity was taken before the drop. The break of structure that came after the liquidity grab is even more exciting for me, as it increases the probability that the downtrend will continue. After identifying all these areas, I mark the region as the place where I expect the price to pull back, starting from the top of the strong bearish candle. I'm waiting for the price to come back to this level. The price has reached the level I was expecting. From this point onward, we have two options, up or down. Our expectation is for the price to move downward. Since the price has reached our area, we move from the MTF to the LTF and start looking for confirmation to enter the trade. The last thing we need to do when determining that the price will move in the desired direction is to seek confirmation on the lower time frame. Let's move to a lower time frame now. Yes, we are on the lower time frame now, looking for confirmation. Typically, we seek confirmation using candlestick patterns or certain structures. Pin bars and engulfing candles are examples of patterns we look for. However, other models can also be used when searching for confirmation. Let's take a look at this together. When the price reaches our area, it gives a short pullback. During these pullbacks, the bearish candlesticks that form will be our focus. On the flip side, if we were experiencing a bullish scenario, we would focus on bullish candlesticks. Now, returning to our setup, after the pullback, the price makes another rise and then gives a small drop once again. What we are waiting for is a candle to close below the last bearish candle. However, this closure should not occur with just wicks. The body of the candle must also close below. In this way, we will have confirmation on the lower time frame. A short rise, a drop, another rise, and then another drop. What do we see here? The candle closes with its body below the expected level. This was exactly what we were waiting for as confirmation. Now we will wait for the price to reach the entry zone during the pullback. Looking at the area before the breakout, we can see a classic doji candle. This candle can serve as our entry point. Alternatively, you can use Fibonacci levels to take trades during pullbacks, but I will use the doji candle in this case. Once the price returns to this level, I will enter the trade. My stop loss will be set at the extreme point of the identified zone. Now, what about the take profit level? To determine that, we'll go back to the medium time frame, MTF. Let's set our TP target together. We are back on the medium time frame, and the chart looks like this. Our SL remains at the level we identified earlier on the lower time frame, specifically at the extreme point of the selected zone. Our TP is set at the lowest point the price created before returning to this identified entry zone. Now that we have determined both the SL and TP, our trade setup is ready. Let's see how the price reacts. Will it respect the zones we identified and hit our TP, or will it hit the SL? Let's find out. In conclusion, successfully trading in the market requires a well-structured analysis process and unwavering adherence to your strategy. Throughout this video, we explored an analysis framework that starts from higher time frames and drills down to mid and lower time frames. We saw how determining the overall market direction on higher time frames is critical for improving the accuracy of your trades. On mid time frames, we identified potential trading zones more clearly, and on lower time frames, we emphasized the importance of entry confirmations and precise risk management. Every trade depends on your discipline and commitment to the plan. Identifying effective zones, recognizing clear confirmations, and targeting realistic goals aligned with your strategy are the cornerstones of successful trading. However, the most crucial aspect of trading is risk management. Limiting your losses and maximizing your gains are essential for achieving consistent performance in the long run. Remember, the strategies and approaches shared in this video are merely guidelines. It is your responsibility to test what you've learned, conduct your analyses, and continuously refine your plans to suit your trading style and preferences. That's why ongoing learning and adaptation are key to thriving in the market. Finally, patience and discipline are the ultimate keys to success in trading. The market will always offer opportunities, but what matters most is executing the right trade at the right time. By applying what you've learned today, you can take more confident steps in your trading journey. I wish you all success. If you found the insights shared in this video helpful, please don't forget to like and subscribe to my channel. Your feedback, questions, and comments are invaluable to me, so be sure to share them below. Until the next video, stay disciplined, stay focused, and happy trading.